Hi everybody, Craig Shacklett from URComped here. I just got done with a meetup cruise. I know a lot of the URCompt family is very interested in investments. I got a few people asking like, hey, can we invest in URCompt? Fortunately, URCompt's not taking any money, but it did pique my interest on just different investments. And we actually have a member of the URCompt family, Djuric, who is the principal of Blake Capital Group. And they've got a super interesting story. And I thought you guys would like to learn more about multifamily investing and Blake Capital Group. So why don't we get to that? Got Ian and Henry, the two principals of Blake Capital Group. Now I could try to describe what you do, but I think it'd be better if y'all do it. So Ian, go ahead. What is Blake Capital?
Blake Capital Group is a real estate investment firm. Think multifamily apartments, townhomes, commercial real estate assets. We invest our own capital along with investors such as yourselves to take down these assets. To date, we've done about $1.25 billion in capitalization with about $300 million going full cycle.
And what does full cycle mean?
Full cycle means we've purchased the property, come in, increased the value, and sold and exited for a profit.
Nice. Okay. Now I know we'll get back into like what exactly that means to add value, what you guys do. But why don't we get into your backgrounds first? So Ian, tell me about your background.
Sure, real simple. Started off as an entrepreneur in college. I started a waste and recycling company, built that from the ground up to one of the top 100 trash recycling companies in the US. Hundreds of employees. Sold that and exited to a PE equity firm out of New York City. Built the second one as well. And then kind of from there, dove into multifamily real estate kind of from the bottom. Started off with about 87 single family homes. Realized I didn't want to own 87 single family homes and I wanted to get to scale. So we dove into multifamily real estate and just continued to scale as rapidly as we could.
Nice. Well, yeah, I've got a million different questions, but before we get to them, let's go to, so Henry, your business partner, Henry, tell me about your background.
Sure thing. So I actually double majored in college in hospitality and in real estate. And after a very brief stint of playing and teaching golf, I decided I wanted to make some actual money. So I went and got my real estate license. I started in just residential sales. From there, I started working with investors in single family homes, similar to what Ian did, and then I started investing in them myself. And I had a lot of what was really just fortunate success in what's called the land assemblage deal, putting together a bunch of vacant parcels of land and selling them to a large home builder. And from there, I got my first, what I would call institutional real estate job. It was investment sales, brokerage for commercial buildings in Manhattan. I worked on a very kind of high octane sales team, which was a lot of fun. I did that for a couple of years. It was really great. And then I moved over to the real estate private equity side, which is just real estate investment with folks like Ian, who are very focused, boots on the ground sponsors and developers of projects like this. So that's actually how I ended up meeting Ian. We probably have put, or at my prior firm, we probably put $40 million with Ian over 7 or 8 investments or so. We got along well pretty much from the jump and decided very recently, just given where things are going from a macroeconomic perspective, that now is probably a good time to get going and start buying together.
Very cool. So Ian, you kind of touched on that you exited your businesses, you had some money to deploy, you bought a bunch of single family homes, and then it was just too big of a headache. You decided to go to multifamily. Now, is that something deliberate, or was it like there's an opportunity to get into multifamily, you bought it, and you're like, this is way better than single family? So yeah, tell me more about that transition into multifamily.
Sure. So when we had the trash company, we were making considerable profits every single year. So we started off as a limited partner, basically investing into other people's multifamily deals while I was kind of building my own portfolio of single family homes. And after selling the trash company, I was like, hey, I don't want to build this massive portfolio of single family homes. And I love the returns and the process of doing the multifamily assets. It provides scale, it's safer, more quality, more institutional, which I love from building the trash company. So I went to 2 of my favorite sponsors, the people that do what we do now. And I said, hey, I'm gonna fund your entire deal. So we put out millions of dollars in personal assets, bought 2 projects. Essentially, we got babysat for 2 years by 2 incredibly smart, amazing real estate owners. And I was boots on the ground, did everything from leasing, property management, construction, you name it. I couldn't learn from a weekend course or a seminar. So I said, hey, you know what? I'm going to pay for my education I put my millions of dollars out there, went and learned for 2 years, and then started scaling on our own and eventually brought in investors from there.
So I understand there's a lot of different types of multifamily homes, different levels, different sizes. Do you have a specific niche you like to target?
So we primarily target, as you mentioned, apartment buildings, multifamily, townhome communities, things like that. Very selectively, we'll look at industrial and self-storage investments, just given their resilience to recessionary environments. But for the most part, we stick to our knitting. And then individually within multifamily, we like to target newer build properties, right? Things that are built in 2000s or later. And that's for a lot of reasons. Curb appeal is certainly one. They're a lot just nicer to look at. From a property management perspective, your tenancy is usually, or your tenants are a lot easier to kind of work with, and is just on a personal level. But probably most importantly, with newer properties, you don't run into a large amount of kind of like just deferred maintenance issues. When you're looking at 60s, 70s sort of build or vintage properties, there can be just these huge kind of maintenance concerns that you don't catch during the contract period, and you walk face first into it, and it's a huge kind of capital expenditure issue. So, with the 2000s and later, it's easy to avoid that as a pitfall of the investment.
Now, you mentioned macroeconomic trends making maybe you shifted away from looking at older properties to more newer properties. Maybe elaborate on that. What are some of those trends that are causing you to shift your focus?
I mean, it's on the front page of everything these days, but interest rates certainly, and most people are familiar with what interest rates do to real estate just from owning or considering owning a home. And that's a pretty close parallel. But the major difference with commercial real estate is that those interest rates affect your debt service payments, and there has to be enough income from the property to cover that debt service, and then have enough left over to pay yourselves, pay your investors, what have you. So what you sort of saw over the last couple of years was a situation where sponsors would take on quite a bit of leverage, right? Like let's call it if like 75 to 80% of the total cost of the project would be leverage, which is kind of a problem, especially when there's floating rate debt involved. So when you have the benchmark rates jump by 4 or 5%, like we've seen over the last 6 or 7 months, that is an immediate kind of like hit to the bottom line in terms of how much you have to pay in debt service. So what that does is it sort of affects how much buyers are willing to pay for properties, right? Because the cost of owning it is higher. But really, that's kind of where we see the opportunity in the market over the course of the next 6 or 7 months. Is a lot of owners are just getting crushed by this higher debt service, and they have to do something because their lenders are getting upset. Cash flow margins are diminishing, and they've got to either put in more of their own money, which no one ever wants to do once they already own it, or just take it out to market and sell it. So that's really kind of what we're looking forward to over the next 6 or 7 months.
So that leads into the next question. So there's buyers now. They're starting to feel the heat of interest rates going up. Maybe they're thinking they could kind of ride it out and interest rates come down. It hasn't happened yet. So how do you find properties that you want to purchase?
The good news is that we're sort of ensconced in it now, right? Ian's been active for a very long time, and we joined up recently. But I come with a pretty deep network of sponsors and brokers and things like that as well. So once you've been in it for a while, the good deals kind of have a way of finding you, right? Like we have all these brokers, sponsors, third-party service providers, appraisers, things like that we know, and frankly, we see more kind of good deal flow than we can handle, and we really kind of get our pick of the litter, which is nice.
And so you're getting more and more deal flow. Do you have a certain process that you go through to decide, okay, this is, something Blake Capital would be interested in, or, no thanks? I mean, obviously you talked about earlier, like 2000 or later. Do you have anything else that you like to look at when evaluating a property?
We're really looking at high growth, high density markets. We're not looking to go be in Albuquerque, New Mexico. We're also not looking to be in New York City. So we're looking at the suburbs of Atlanta. You're looking at things like Huntsville, Alabama, Tampa, Florida, Jacksonville, Florida. Really high target, high profile markets that have a great resale opportunity, as well as allow us to get in for a decent cost basis.
And so you'll get deals from Albuquerque, whatever. You say, no. Somebody says, hey, I got something in Tampa. Do you generally fly out right away to look at it, or are there some things that you do remote, and then what's kind of your typical due diligence process?
Sure. So when we get the deal in, we're requesting certain documents, requesting a rent roll, a T12, kind of an understanding of the property's financials. We'll take those documents, put them into our underwriting model, do all of our back-end math, put into our plan, hey, does the property cash flow? What do we have to do to improve the rents? Do we have to come in, add new countertops, add backsplashes, redo the entire kitchen, redoing bathrooms? Does it need a new roof? We're kind of creating a game plan there within our underwriting. And then if it kind of hits all of our buckets and we can get an investor return that fits, we'll submit an LOI, which isn't a contract, which is a letter of intent. They'll say, hey, this letter looks great. We fly out, go look at all the comps in the area, understand the market and the sub-market and dive in real deeper. And then we go to a contract on the property and move forward.
Now, are there certain areas where, like there's probably some things that if they put in writing, they're not lying about that. That's going to be true. But maybe there's certain things where you're like, okay, I want to see this with my own two eyes before going any further.
So the biggest thing we do is when we go into contract, we have 30 days of due diligence. This means that we take the entire team, load them onto a plane, and fly out to the asset. So we bring everybody from our construction management, our property management, our underwriter, myself, Henry, and we go out we walk through every single unit that's on property. We photograph so we can go in and say, hey, we're actually going to be renovating each piece of each room. So we can itemize into our budget, our CapEx budget, how much we're actually going to spend everywhere inside. 2, we're looking at the roofs, the siding, the dog park, or does it have a dog park? Can we add a dog park? So basically going through understanding every piece of the interior and exteriors, how much does it cost us to do these things? We're also going ahead and looking at all of the comps in the market or our competitors. Hey, is the apartment project a mile down the road achieving $300 more in rent from us? Okay, cool. What are they doing that's different? Is it just amenities? Do they have a way nicer pool? Do they have a dog park? Or do they have granite countertops? And I have Formica countertops. So if I can go ahead and add granite for $2,000, I can get $100 in rent bump. That's amazing. But it's really, we don't just take some financials in, put it into a model and go buy stuff. It's a expensive process. We fly out 10, 15 people, dive into this asset and really get a true understanding of it before we complete the purchase.
And when you go and you evaluate, there's people living in most of these units. Are you actually able to go into every unit, or it's kind of you see the vacant ones, or?
No, hey, we go into every single unit. We knock on every single door. We will not buy a property unless we get into every single unit.
Wow, that's awesome. Okay, so you go through all that process. You decide, all right, there's something here. You close. What do you do right away? Like, what are your first steps after you close on a multifamily home or multifamily investment?
So it goes back to the prior question of where did we see the value, right? Like, are expenses running high and we can bring those down? Are rents low and we can push those up? Sometimes sellers are just not paying attention. They go on the property forever, rents are low, and it can be just as easy as pushing rents up to kind of competitive property rates. But really kind of where I think we have a leg up, I suppose, is just given the kind of portfolio size that we have. We have a lot of great relationships with like third-party service providers, general and subcontractors, and waste management, and even like landscaping, things like that. So our costs are typically, lower than they would be for a smaller firm. But in terms of what we do first, I think it would probably just be the low-hanging fruit that we think would drive a lot of value. So, while we were sort of in that due diligence process where we knocked on the door of every unit, we're like, all right, what's the quickest, easiest thing we can do that we think would make this more appealing to a prospective tenant, and just kind of knock out the easy stuff first.
And do you generally knock out those things while people are still during their term, or is it like as people are churning, you're like, okay, we are doing the upgrade and now rent's going up, or how? Because that's got to be difficult too when you've got people that are constantly month by month turning over.
So that's a good question. Some of those things, or I guess property improvements, don't have anything to do with the interiors of the units, right? Like if it's as simple as some signage, some landscaping, and just making
dog park.
pretty.
You mentioned that earlier.
Yeah, do whatever you need to do, and frankly, the residents are just as happy as you are to kind of have those sorts of things going on. In terms of the interior renovations, what you're speaking about is something called a unit turn. Anybody that's ever rented an apartment knows that there's that period during which between where they move out and the new person moves in, where the maintenance crew comes in and fixes all the holes in the wall and does all the stuff. During that period is usually when we will do the renovations to the units to the extent that we have budgeted for that. Obviously that takes a little bit longer, but again, that goes back to having like good subcontractors, good general contractors who know what we like, and we trust them to kind of do it in an expeditious manner, I guess.
To kind of dive a little deeper into that, part of our underwriting process at the beginning is planning on how many unit turns we're going to turn a month. So if it's a 300 unit property and we want to get everything done in 2 years, we take the math, we have to turn 8 units a month. So we're going through our rent roll, seeing, hey, who's coming out for lease? We simply take over that unit, plug it out. It's not random, it's organized, systematic. And hey, we know we're going to turn 8 units this month. We've already pre-ordered the cabinets, pre-ordered the granite, pre-ordered everything. So we can step in, renovate as quickly as we can, and get a new tenant back into that unit paying rent.
Now, you touched on some of the property-wide things, not inside of a unit, but like a newer pool. Dog park kind of perked my ears up because that's something that I don't think 20 years ago anybody was doing dog parks, or it was very rare. It seems like now every new building you see, we're in Dallas, every new building you see is like dog park. Oh, yeah. Like so dog park, anything else you see is like kind of the hot thing that all multifamily properties are trying to get.
One of the biggest things we do is truly try and understand our tenant demographic and what our comps are offering, because not every property is the same. Obviously, a 2000s property where someone pays $1,200 in rent is different than some of our A-class properties where someone pays $2,400 in rent. So we have a 2007 400 unit, $80 million asset in Houston, Texas called Park North. And we're actually putting in 4 pickleball courts because that's what our tenant demographic wants, is pickleball courts. I've never played pickleball, but it's what's the trend in the market. It's what people want, and we're going to put it in. We did a whole survey of like, hey, what new amenities are people offering in the area? What do tenants want? And it's really just giving people what they need and a reason to want to be there, a reason to want to pay more in rent, and a reason to stay.
Okay, so you buy a property, you make your improvements, you increase rent, you get more out of the bottom line. How long do you generally like to hold on to an asset?
Sure, so we typically do a 3 to 5 year hold at all times. So at the end of the day, if someone wants to come in year 1 before we're done finishing our business plan and say, hey, and Henry, here's your performance price that you guys plan to, we're going to take that. So over the past couple of years, that's tended to be more of the trend. We've come in, started the business plan, and 12 to 15 months or 18 months in the line, people are literally coming to us, hey, we want to buy the property. Hey, we want to buy the property. And we're like, sure, we'll look at the offer. Then they offer more than we ever planned to sell the property for. So it's, thank you very much, here's the keys. And our investors do a great amount of time. But we always traditionally say, hey, it's going to be 3 to 5 years. This is our systematic approach to coming in slowly and systematically increasing the value of the property and selling it at the new value of it. So it's not a get-rich-quick scheme. It's not come in and flip a house in 90 days. Like, these are large commercial multi-million-dollar assets. So we take more of that systematic approach to it.
You kind of answered this question. And no, I mean, you answered the last question I had, but I'm leading to another question. So you said there's like a 3 to 5 year window, and sometimes the trigger event could be somebody just comes out of nowhere and says, I want to buy this.
Yep.
But let's say somebody doesn't make an unsolicited offer. When do you decide, okay, it's ready, let's go to market? And then what's that process of going to market like?
Sure. So there's people called brokers, just like when you sell a house, there's real estate agents, but in the commercial space, there's tend to be like commercial brokers. They all work on commission. So they want to get you the most money they can for the property. And they'll compete with each other for the listing, obviously. So I'd say after 12 to 18 months, you have a broker too, they'll start coming in and saying, hey, can we give you an opinion of value? Here's how much we think the apartment complex is worth or the storage complex is worth and what we can sell it for. We're not looking to sell, but if someone comes in and is offering us a price that's absolutely amazing, we take a look at it. So it's basically pretty much every year, 2, 3, 4, 5, we take a look at the pricing, what the property is worth, and is it the right time to sell? Or can I do a complete refinance in year 3 and return all of our investors' capital so they have all their money back, and then hold the property for 10 years with just free cash flow for our investors? So it's really the benefit of having that 3 to 5 year time period is we're not stuck in, hey, I got to come in and turn this property in 6 months and move on. It's, I can evaluate the exact right time to sell this property, and if it's not the right time, I can continue to hold safely throughout the rest of the whole period.
All right, so when you're buying an asset, obviously you raise a lot of money, you got a big bank account to deploy, but you're also, I'm assuming you're partnering with banks and other source of capital. So like when you buying an asset, is there a certain percentage you generally stick in with, like how much of your own money you deploy versus bank funds?
Sure. So it's kind of like we talked about in the last question. Usually a bank or some other lending institution will provide anywhere from 60 to 80% of the required sort of capital to fund the entire project. We like to stick closer to the 60 to 65% mark so that we don't end up in trouble, similar to what a lot of folks are seeing these days. As the interest rates went up, their loans are too high leverage, they're getting squeezed a little bit. So we try and stay on the more conservative side there. And then in terms of the rest of the capital, that 40 to 35% that's remaining, there's a portion of that is our money personally, and then a portion of that is money that we raise from investors, both individuals and sort of institutional equity providers, which is what I was doing at my last shop and how we got together.
We are an investment firm at the end of the day, and we're here to provide returns to our investors. However, our number one job is to preserve your capital. So we're always going to be that firm that's going to make a little bit less money to put into a less riskier investment. So we're not a high leverage company, we're not high octane, we are steady and stable return focused.
Now, we touched on it earlier, I'm going to re-ask it though, about how high interest rates are affecting the market. So that's, obviously you have a little less exposure if you're deploying more capital than others, right?
Right.
If you've got 65% of variable interest versus 80 or
Yep,
more.
exactly.
But just in general, how has the high interest rates affected the market?
Well, it's like we talked about. You've got a lot of current owners that took on high leverage loans with adjustable rates. Benchmark rates have gone up, faster than they have at any point in the last 40 years. So their cash flow margins are just getting squeezed because the debt service that they're having to pay is higher. And in commercial real estate, lenders will have certain what are called cash flow covenants, right? Like if cash flow gets too tight, it turns into sort of an issue. Also, you have a lot of loans that are coming due that were issued over the last 3 to 5 years. And when that happens, you either need to be able to take out a new loan to take out the old loan, or you have to sell property, or you have to put in your own cash, which nobody ever wants to do. And because the lending environment is tighter now, like these new loans, these same owners can't get loans that have enough proceeds to cover the old loan. So their only choice really will be to sell or put in more of their own money. So that's really kind of where we're starting to see the opportunity, and I've really noticed it in like the last month and a half. Sellers just finally coming down to earth a little bit on what their property is worth. Prospective buyers like us have been saying it for like the last 6 or 8 months, like, guys, you better start paying attention. But from our perspective, it's nice to see it finally coming around, and I really think the next several months are going to be just promising.
One thing to add to that is, one of the reasons there is a lot of opportunity is because of that not fixed debt rate. One of the things that we are targeting is fixed debt. So just like in a single family home, you can go with Fannie Mae or Freddie Mac. They have commercial real estate loans as well. We call it agency loans. So we're targeting Freddie Mac, Fannie Mae with fixed rate terms. So we know we're going to pay 4.5% or 5% throughout the course of that entire term. It allows not as much flexibility because we have to stay for that whole period, but we know exactly what we're paying. We can underwrite exactly to what our debt costs can be without the fluctuations. So again, less risky.
All right, so before our interview, I'm obviously poking around your website. What's your website again? We should plug that.
It's blakecapitalgroup.com, super easy.
Easy peasy.
Yep.
Okay, so Blake Capital Group, you talked about preferred returns on the website. What are preferred returns?
A preferred return is real simple. It's a return that our investors are entitled to before we at Blake Capital Group make any money. So at our fund, we have an 8% preferred return. So our investors are going to make 8% on every dollar they put into the project before we make any kind of a profit whatsoever. So Craig, if you invested $100,000 to the fund, you're entitled to an $8,000 return each year before we at the company make any kind of a profit.
Okay, so you talked about your origin story a little bit, how you exited from a couple companies you started, and then you started investing with your family office, your own wealth that you built from your companies. What led you to start a fund where you took money from outside?
Real simple. We started off with friends and family asking to kind of come and join us. And then we only can take in so much capital per individual deal. So with a fund, it kind of allowed us to give access to all of our friends and family that wanted to come into it. as well as give them diversity across the portfolio. Like for example, my dad, big corporate executive guy, has his stockbroker and he has all of his money in his stock and bonds portfolio, and he's kind of watching what we're doing. He's like, hey, like, that's really interesting. I only invest in stocks and bonds. Let me try it out with you guys. So my dad invested $100K his first time into our thing. Absolutely amazing return. And now my dad's a repeat investor into every deal we do. But it's kind of a nice diversification from being just stocks and bonds to being able to do the real estate thing. And having a fund allows us to take in more investors than just the first 20 people that say, hey, I want to invest in and take up the whole slug. So.
Yeah, and just to kind of expound on that a little bit, we're lucky to have sort of been around for a while now, and as I mentioned, we have that a just great amount of deal flow coming in, and to have sort of dedicated capital that is able to act on those deals, it positions us well with prospective sellers, right? Because we have the money, it's all available, and we can usually negotiate better terms that way. And then from our investors' perspective, it's also if you invest into a commingled fund like we're discussing. Your investment is spread across 7, 8, 9 different assets as opposed to high exposure to one single investment, so a little bit of risk mitigation through diversification, I guess.
Now, how big of a jump is that going from your family money to taking on outside investment? Is that, do you have to register with the SEC, or like what are the processes? Because that seems like, I would assume that's a big step, but maybe not. What is that like?
So in terms of raising capital, it's something we've done before, from building up the trash and recycling company at a large scale and exiting private equity and staying on with the wrap-up and roll-ups. Raising equity and dealing with institutional investors is something that we do on a daily basis. So another reason we're doing the fund is that a bunch of our other deals are getting fully taken up by one institutional investor. We built up an amazing track record. Some of the larger institutional groups are like, hey, we're going to come and invest the whole $20 million into the deal, and then I can't even put my dad into the deal. So the fund allows us to kind of let everybody come in. But everything we do is a 506C. It's registered with the SEC, allows us to follow a set amount of guidelines with how we raise money. So everybody has to be an accredited investor. Set guidelines, as long as you meet all the accredited investment guidelines, you're able to invest in our fund.
And it bears stating that we have highly experienced compliance counsel, things like that, and we've done this plenty of times now. So all very kind of regimented at this point.
So I've heard it said that you can, in these private placement deals, you can, if you have a self-directed IRA, you can deploy money. It doesn't all have to come out of your checking account. I mean, tell me about that. What are some options for like people that have never invested, like maybe like your dad, that have never invested in anything other than stocks and bonds? Like, what are some ways that they could invest?
Real simply, I mean, there's a thing called the self-directed IRA. It allows you don't have to mess with your entire IRA account. You can move $100,000 or $200,000 into a self-directed account. And in a self-directed account, you can invest in any kind of a private placement, from industrial, self-storage. You can buy your own property if you want to through self-directed. But a lot of our people that are looking for diversification outside of just their stock and bonds will move $100,000, $200,000, whatever they may want their comfort with, into a self-directed IRA and invest into one of our private placements or someone else's private placement. And it's a way to keep your money in your IRA and still make a higher than average return compared to your stock portfolio.
And I would say if anyone has any more questions about that, just reach out to us directly. We have a couple of self-directed IRA custodians that we like quite a bit. So happy to kind of guide through that process.
Now, do you do disbursements, distributions, like during the course of the fund? So because you touched on earlier, is you buy an asset, you invest in it, but hopefully it's cash flowing during the course of it. So how does that work? Like, do investors just get money at the end when you exit, or like what is that like for your investors?
So it's a combination. So for the fund, we're targeting a 7.7% cash-on-cash return and a low 20s average annual return overall. So we target properties, again, that cash flow from day one or within the first couple of months. We come in, take the property, spend a bunch to get it going, make sure it's stabilized properly, and then every month we get your ACH information in the beginning, and we automatically send you a payment every month for your share of the profits. So we're targeting, again, 7.7% cash-on-cash return. And then at the end, when we sell all the properties, you're gonna get that larger check or bonus at the end, which really gets you to that 17 to 20% average annual return.
And so the funds, the fund has a certain life cycle, and so at the end of it, you close it out, and then everyone gets kind of a lump sum. So how often are you starting up new funds, or what's kind of your goal as Blake Capital with that?
Yeah, I mean, I guess just to sort of touch on the wrap up of the current fund, it very rarely happens all at once, right? Because if there are, let's say, 7 different assets within this fund, and as we mentioned, they might differ in terms of when it's most opportunistic to exit. We might sell one after 3 years, one after 5 years, one after 6 years. So as that kind of happens, and we sell the properties at those stages, that's when the kind of principal and profits are distributed. So it won't be one big lump sum like right at the end of year 6. It'll be sort of like staggered based on the individual business plans of the underlying assets. And then in terms of future plans, I mean, there's no reason that I can really think of not to stick to our knitting. I don't think. We've been very I guess fortunate, but also diligent, and our track record is encouraging. So we're just gonna keep doing what we're doing. I would imagine, raise more and more, raise larger and larger funds, get more and more folks involved, and just keep going.
Now, are there, I guess more thinking from my own perspective, as a potential investor, what are benefits? Are there tax benefits of investing in this real estate versus stocks and bonds?
There are. So the kind of quickest and easiest to understand is depreciation, and most people are familiar with that if they own a home. Depreciation is, generally speaking, the IRS says, okay, you own a piece of commercial property, it's going to deteriorate physically over time, and instead of getting too into the weeds on each property, they just say, okay, here's your 40-year depreciation schedule. Every year your property depreciates by an equal amount over those 40 years. So basically what they say is whatever that dollar amount of that depreciation is, you can offset that against income from the property, so that that port, or the difference between the two is not taxable. It's tax deductible. So we're going to take it a step further. It's pretty common practice these days in commercial real estate to perform something called the cost segregation analysis. And basically what that is a very specific sort of cost seg surveyor comes out, and he will look at each individual component of the physical property. Is like, okay, the piping, the drywall, the roof, all that good stuff, and he will sort of depreciate those things on an individual basis. To make a very long story short, what that effectuates is very accelerated depreciation over the first 3 to 5 years of the whole period, so that essentially all of the income that you receive from the property, depending on the results of the survey, all that income is tax deductible. So that 7.7% distribution that we're targeting is all tax-free to the extent that cost seg analysis supports it, which it usually does.
And do all the investors get a K1 every year? Is that?
Yes, that's correct.
Obviously, I think in the URComped family, there's a lot of people that may be interested in this. I know I am, but do you guys put up your own money in this? Is this something you got skin in the game?
Sure, so we always try and be aligned with our investors. So we're not just sitting here benefiting off profits, like our money's in there with yours earning at the same level. So if we're raising a $50 million fund, we're gonna put in at a minimum $5 million, or 10% of the total amount of the money in there. So every year, if whatever that number is, we'll guarantee to put in a minimum of 10%. Sometimes we do put in more though.
And then there's operating expenses, right? So how does that work in the fund? So you raise the fund, you buy assets, and then, I guess there's got to be a percentage, right, for running the business?
Yeah, at the individual asset level, when as we buy these properties, there are property level expenses, and that's all sort of handled at the individual asset level. In terms of running the fund, we'll take a 1.5% asset management fee, 1.5%, which is I would say below the industry average, but still enough to keep the lights on, and then a very small line item for general and administrative. But as Ian mentioned, our money's in the fund with our investors, and the real sort of profitability for us comes if the fund performs well, right? The purpose of those sort of asset management fees and G&A is just to really keep the lights on, so that we can keep doing what we're doing until we get to those exits.
Well, of course, and you got to fly to different markets to evaluate properties and bring out your team so it makes sense. You need to have some cash flow to do those operations where your limited partners probably obviously don't have those expenses, so it makes sense.
Right.
Well, if somebody, this has been super interesting. I know I've learned a lot as a newbie that doesn't know anything about multifamily investing, now I feel like I do. But if somebody wants to learn more about Blake Capital and what you're all doing, potentially even get involved in the fund, where should they go?
As you mentioned, our website, blakecapitalgroup.com, has a lot of good information, both on the fund and on our firm. Our contact information is super available, so the best thing to do is probably just shoot us an email, give us a ring. Happy to shoot the breeze for a while.
Perfect. Well, hey, thank you guys both for coming out. I know you have a property in Dallas, right?
We do. We just bought a 320 unit property right there in Dallas, so we're actually headed there right after this.
Perfect. Well, hey, thank you so much, guys. It's been a pleasure.
Yeah, it's been great. Thank you for having us on. We certainly appreciate it.
Thanks again, Craig.